500 companies or 3,600. Pick one. You only get one for the next 30 years. Same company runs both of them, same fee structure, similar dividend check, and over the last 10 years, they finished about 1% a year apart. So why is there a debate over this? Because there is one real difference between these funds. We are going to go over performance, dividends, what's inside each fund, what 100 grand looks like in both, and at the end, what happened to each one in a severe market crash. Performance first, because that's what you came for. VOO holds the S&P 500, the 500 biggest companies in America weighted by size. 10-year average return, 15.47% a year. VTI holds everything, roughly 35 to 3,600 companies, from the trillion-dollar mega caps all the way down to businesses you have never heard of in cities you have never visited. 10-year average return, 15.04% a year. VOO wins. Now look at how little it wins by. 3 years, 20.58% against 20.43%. 5 years, 13.36% against 12.24%. The largest companies have carried this entire market for a decade, and VOO is nothing but giants. VTI owns the same giants, but it also carries about 14% of its money in mid and small companies, depending on how you classify the stocks. And those have been dragging VTI down. But if you go back far enough in history, like 100 years, small companies have actually beaten large ones. The last decade we just lived through was the exception. If that relationship ever snaps back, VTI is holding the companies that benefit and VOO is holding none of them. It's real money. 10 years, $10,000 in each. VOO gets you to about $34,000. VTI, and you're looking at about $1,300 less at $32,000. Dividends reinvested in both, you're seeing a similar spread, but $40,000 for VOO and about $39,000 for VTI. So VOO is technically better in the past 10 years. Now let's talk about dividends. VOO yields about 1.03%, VTI yields about 1.02%. That's it. That's the whole difference. On $100,000, VOO sends you roughly $1,030, and VTI, they send you about $1,020. We are arguing over about $10 a year. You could find more money cleaning out your couch or your car. Size and cost, quickly. Both of these are among the biggest funds that exist. Both are from Vanguard. VOO manages about 1 trillion AUM and VTI 663 billion. There is plenty of shares to trade throughout the day, so no big deal here. And the fee, 3 basis points each. On $10,000, that is $3 a year for either one. So cost is tied, yield is tied, fund company the same. You are essentially buying the same thing here when it comes to these measurements. Building a real portfolio out of pieces like this with actual dollars and actual position sizes is what I spend most of my time inside the Boring Money Club on Patreon. My real portfolio, monthly updates, the full back test behind these charts. If you want to build alongside people playing the 30-year game instead of the 30-day game, the link is in the description. And now we can end the debate here because these are the real differences. Here's what you own in VOO. Apple, Microsoft, Nvidia, the usual suspects. Those 10 names are about 36% of your money, whether you signed up for it or not. You are making a concentrated technology bet. And here's VTI. Same 10 names, same order, just slightly smaller slices, about 32% instead of 36%, because they've been spread across 3,000 more tickers. Sectors, same story. Technology sits at about 39% in VOO, and 36% in VTI. Everything else lands within a point or two. Hold on to that tech number, it comes back to us in the crash. Now the number that explains everything. These two funds overlap by about 87% by weight. For contrast, when I compared VOO and SCHD, the overlap was single digits by weight. Two completely different portfolios. That is not what's happening here. VTI is VOO with the tail attached. 3,000 smaller companies making up around 14% of the fund. So stop thinking of this as two strategies. There is one strategy and one question. Do you want the tail of those 3,000 companies or not? Let's find out what the tail is worth in dollars. $100,000 in fact. What actually shows up in your account? VOO. We're talking about 147 shares. If the next 10 years rhyme with the last 10, that 100 grand roughly becomes $341,000 or about $400,000 reinvesting the dividends along the way. VTI about 275, same math and you land near 328,000 or $386,000 reinvesting the dividends. And the tail costs you about $13,000 to $16,000, depending on whether you are investing dividends. Not nothing, but read the assumption baked into that number. It assumes the last decade runs again. It assumes the giants keep outrunning everyone else for another 10 years. Change that one assumption and the chart inverts. If small and mid caps get their decade, VTI holds them, and that same math runs backwards. I don't know which way it breaks, and neither does anybody else. And there's 1 week in market history where the projection stops mattering. September 2008. Lehman goes under, the system nearly seizes, and the S&P 500 loses more than half its value from top to bottom. VOO wasn't there. It didn't launch until September 2010. So for VOO, I have to use another ETF, which is the SPY. The S&P 500 fell roughly 55% from peak to bottom. VTI was there. It launched in 2001. VTI fell the exact same, maybe a few dollars different, but not enough to make any real changes. $100,000 at the 2007 peak became roughly $45,000 at the March 2009 bottom. In either fund, 3,000 extra companies bought you nothing, because when a real panic hits, everything correlates and everything sells. Diversifying inside the country's stock market is not diversification when that whole market is on fire. Then the part people underestimate, not the crash, it's the waiting. It took about 4 to 5 years just to see your old balance again. 5 years of opening your account and feeling nothing but regret. And the small caps in VTI actually bounced harder off the bottom. So VTI got back to even a little sooner. Then the 2010s happened. The giants went on the greatest run in modern market history, and VOO's concentration pulled it back ahead. In the crash, they're twins. Off the bottom, VTI gets a short head start. Across 15 plus years, VOO's concentration edges in front. So ask yourself the honest question. Would you have held through losing half your money? Because these two funds, there's no gentler option, no defensive tilt, no fat dividend landing in your account to take the edge off. Whichever ticker you pick, you're strapped in. And as I've said before, the fund you stick with beats the fund you abandon every single time. Bottom line, VOO is the 500 biggest, more concentrated in whatever is currently winning. And it has been the better fund for a decade. VTI is every public company in America in one ticker, and it's the fund that wins the day small caps wake up. Identical cost, identical yield, identical crash, and roughly 87% of the same portfolio by weight. And owning both does not diversify you. It just gives you two tickers doing one job. My opinion as a long-term investor, I hold VOO, mostly because the S&P 500 has the long history my indicators need. So I know when to trim and when to accelerate my purchases. If what you want is one fund you never think about again that owns a slice of everything, VTI is completely defensible. And the honest truth is the gap between them is small enough that staying consistent matters more than which one you bought. So tell me in the comments, VOO or VTI, and what made you pick it? If this video helped, subscribe for more ETFs and other breakdowns. My full monthly portfolio and my monthly updates are in the Boring Money Club. Link is in the description. And if you want the comparison where the two funds are genuinely different, VOO versus SCHD is right here. I'll see you in the next one.